Okay, hello everyone. Today I'm going to cover chapter 8, and we're following the same format. This video lecture is basically going over problems, and the content, the lecture content, is in Canvas, right? So I have a series of maybe 7 to 8 videos. They're probably 3 minutes to 5 minutes each, and we'll go over in more detail of these concepts. Right now, I'm going to go ahead and share my screen, and we'll start with the chapter 8 practice questions. Just like we did in chapter 7, we'll do the same thing for chapter 8. Okay, in chapter 8, we're talking about fixed assets. Those are assets that you can touch, like equipment and I guess even buildings, right? And perhaps land. Now we don't depreciate land, of course, but we do depreciate other fixed assets such as, equipment and buildings. So before I told you that you need to glean at least 3 bits of information to solve any depreciation problem. It's cost, salvage, and useful life. And I demonstrated before, like in chapter 3, the straight line method. And what is a straight line method? Well, it's just one of the rules of the game, right? Depreciation is a systematic allocation of an asset's cost over several periods. So there's a handout that I gave you before, and we worked it through so you could review that. But when I say a systematic allocation, well, how are we going to systematically allocate it? Well, the one that you know already, or you did maybe by chapter 3, you probably forgot it. That's what happened to me. I go to the next chapter, I forgot what the previous chapter was. But you know that under the straight line method, the rules of the game is this formula: cost minus salvage divided by life. Okay. So what we'll do is we're going to be calculating depreciation on this machine for the first and second year. Okay, so we'll start out with the formula: cost minus salvage divided by life. Cost, $38,000. Salvage is $2,000. Now, if you recall, salvage is what we think we're going to get back at the end of the asset's life. Okay, so we bought it for $38,000, but we think that we're going to get $2,000 back at the end. That's our salvage value. So we're only wanting to depreciate $36,000, right? The $38,000 minus the salvage value of $2,000. So we're only going to depreciate $36,000. This is called depreciable cost, if you recall. Okay. Well, then also, how long are we going to depreciate it? For 5 years. So this numerator, which is 36,000 divided by 5. So we're going to be depreciating this asset $7,200 per year over the next 5 years. 7,200. So what's the first year depreciation? It's expense. It would be 7,200. What about year 2? If I was doing this live, I might have not showed you the answer. And what's the depreciation expense in year 2? And you'd go 14,400. No, that's accumulated depreciation, right? You're going to accumulate it, but the depreciation expense will be the same, right? And that's the hallmark of straight line method. Every year we depreciate by the same amount. Okay. Now, We all know and love that one. Let me show you another one. Well, it's just another way to systematically allocate. It's called the double declining balance method. Okay. So I'll just do it right here for now. So what we need to do, the first step in double declining balance method, and this is the rules of the game, we have to figure out the double declining balance rate. Okay, what's that? That's twice the straight line rate. And you say, Tetra, that means nothing to me. Okay, I understand that. I can appreciate that. But this is how you would do it. Hold on, I'm going to close the door. My dog is starting to bark. I do appreciate my dog because I really feel safe from the garbage man and from the UPS driver, all those guys, you know, or I'm okay with because he'll take care of me. All right. Anyway, back at the ranch, recall that our asset will be depreciated over 5 years. So that means that every year we're going to depreciate 1/5, right? 1 out of 5 years. And what's 1/5? That's 20%, right? Well, we're going to double that and make it 40%. Okay, so that's one way you can do it with the fraction. 1 divided by 5 is 20%, and you double it 40%. But I like to do it this way. I like to do it like 100%, which is the whole thing, and we're going to do it over 5 years. So each year we're going to depreciate 20% of the asset under straight line, right? So just take 100% divided by 5, which is the useful life. So 20% per year. But we need to double it because that's what the double declining balance rate is. It's double the straight line rate. So you take that 20% times 2, and now you get 40%. Now, the next thing that you need to do is just create a table. Okay, now my table is a little bit simpler than the book, and I think you're going to have to do it the book way, which they just give you more information, but it's the same principle. But this is how I set it up, and you can take a look at it. You put in the year, the beginning book value, the rate, depreciation expense, and then the ending book value. Okay, so the calculate depreciation in year 1, we're going to start out with beginning book value, which is $38,000. Do you remember that the cost of the asset was $38,000? Well, that's what we're using. Now, notice that and the other methods that we're going to be doing, you're going to subtract out the salvage value. You'll be using $36,000, not in the double declining balance method. You have to remember, we're going to use cost. Matter of fact, that's what I did here. Cost. So we take 38,000 times the rate, and you just put it in here, 40% year 1, 40% in year 2, and you just keep doing that. Just put it in. So it's 38,000 times 40%. So my depreciation is 15,200 in the first year. Okay, so we depreciated 15,200. To get the ending book value of year 1, we take 38,000 minus 15,200, which is the amount of depreciation. So we end up with a book value at the end of year 1 of 22,800. Now the ending book value of year 1 becomes the beginning book value of year 2. So we just copy it over. It's a copy job, put it there. And we'll do the same thing. 22,800 times 40% will give us 9,120. That's our expense. And that's as far as that we need to go in this problem, because I just wanted you to calculate the depreciation for year 1 and year 2. Now, one thing that this method or this illustration here doesn't show you that you can never go below salvage value. So let's say that you're in year 5, you've done this, for year 1, you've done it for year 2, you've done it for year 3, you've done it for year 4, you've done it for year 5. But when you do it, if you do the full amount, that the ending book value will go below the salvage value. You can't do that. The last one, if it goes below salvage value, you've got to adjust this depreciation expense. You got to lower the depreciation expense so that at the end, your ending book value will be salvage. So if the last year, don't go below salvage. Just adjust it so that it won't go below salvage. Okay. So anyway, that's double declining balance method. All right, we've got one more for us today. It's called the units of production method, right? And we're going to use this information. You know what? When you do your homework, when you read the problem, glean this information. You're going to need cost, salvage, and useful life, right? Now, except when you do the units of production, we're not going to use years. We're going to, instead of the useful life of 5 years, we're going to put in the total units of production, the 70,000. This widgets. This is like the amount of widgets that this machine is going to be able to produce. So that's where we get the 70,000. We over the life of this machine, we believe that it's going to be able to produce 70,000 widgets. Well, how do we do this? Well, let's talk about this. Let's assume that 16,000 widgets were produced in year 1 and 13,000 widgets were produced in year 2. Well, what we need to do is find out how much we're going to depreciate per widget. Okay, so the formula for this, how are we going to systematically allocate it? The rules of the game is this: cost minus salvage divided by total units. The other one was cost minus salvage divided by useful life. This one is cost minus salvage divided by total units. Okay, so let's put in the cost, 44,000. Salvage, 2,000. So that's 42,000, right? And so we're going to be depreciating 42,000 over the life of the asset, and we know that it's going to be able to produce 70,000 widgets. Well, if it costs 42,000 and we can produce 70,000 widgets, that means that we should depreciate it at 60 cents per widget, right? For every widget we produce, we're going to depreciate it by that much. So check this out. In year 1, we assume that 16,000 widgets were produced. We'll multiply by 0.60, right, by 60 cents. We're going to depreciate it 60 cents for every widget we produce. So 16,000 times 60 cents equals 9,600. Now, in year 2, we assume that we produced 13,000 widgets, right? So in year 2, 13,000 widgets times 60 cents. So we'll be depreciating 7,800. Okay. All right, let's continue on. Now, usually you don't depreciate the asset for one full year because not all your assets are going to be, purchased on January 1, right? And so for between January 1 and December 31, yes, one full year of depreciation. But what happens if you purchase that machine on November 1 and now it's December 31? What we have to do is depreciate only 2 months of depreciation, right? So from November 1 through December 31, that's 2 months. So we need to depreciate just for 2 months. Well, how do we do that? Well, first off, we're going to calculate depreciation for one full year, right? And then we'll apply a portion of the year. In other words, here we're going to be going 2 out of the 12 months. Okay, let's go ahead and do this. This is straight line. And we're just going to go and apply the rules of the game. Cost minus salvage divided by life. The cost, $125,000. Salvage, minus $5,000. And the useful life, 10 years. So if we calculate that out, this is going to be $120,000. We're going to depreciate that over 10 years. That's $12,000 per year. Now we know that's $12,000 per year, which is good, but we only want 2 months, right? 2 out of the 12 months. So we just prorate it. So we have $12,000, which is for the year, times the partial year, 2 out of the 12 months. That would give us our $2,000. So 12,000 times 2 divided by 12 equals 2,000. 12,000 times 2 divided by 12 equals 2,000. Now, as I mentioned before, some of you guys I know do not like fractions. You didn't like them in grade school and you don't like them as an adult. I totally get it if you don't work with them. I tend to like it because I've done this a lot. It's just real easy for me. I like to do one fell swoop. 12,000 times 2 divided by 12 is 2,000. It's easy for me. But if you don't want to do that, you could do it this way. You know that is this right here? Yeah, it's 12,000 divided by 12 months. Okay, so that means that's that's $1,000 per month, right? You got $12,000 per year. You divide it by 12. That means you're supposed to be depreciating $1,000 per month. Well, we don't want just $1,000 for 1 month. We need 2 months. So we just take that per month figure, the $1,000 times 2, and you get the $2,000. Okay, so that's partial depreciation. You'll have to do that in your homework. Oh boy, this is really fun. And of course, I use the term fun loosely around here. Actually, I think it is kind of fun. It's at first glance, you go, oh man, this is really, really difficult. But I think how I did it here, it kind of shows you how to do it. I think it's kind of interesting is that when I was a student, I didn't learn this until intermediate accounting. I learned this at Fresno State in the upper division 120A. They're pushing it down to the beginning accounting classes. So there you go. I didn't make the rule, but that's the way it is. But it's not that bad. And what I do like about my example here is it kind of leads you down the path so that you can kind of understand what's going on. What we're doing or about ready to do is we are going to dispose of equipment, or we're going to sell the equipment. Now, when we dispose of the equipment or sell the equipment, if it has a book value, in other words, there's still book value on the balance sheet, and you're getting rid of it, well, that could cause a loss on disposal, or it could be a loss on sale, or it could be a gain on sale. You can make some well, it's kind of like revenue, but it's other revenue. It's not part of operations. But anyway, yeah. So you got to account for that. So let's just go through the paces and show you what I'm talking about. Lopez owns equipment that cost $90,000 with accumulated depreciation of $50,000. So the first question is, what is the book value of the asset? Well, we know, or at least you used to know, you may have forgot it, that book value is the cost of the asset less accumulated depreciation, right? So in this case, the asset cost us $90,000. We've depreciated $50,000 of it. That's why it's accumulated depreciation is there. So we have a book value of $40,000. Now, we are going to sell that equipment for $45,000 cash. So what is the gain or loss on sale be, right? What is the gain or loss on sale? Well, if we're getting cash of $45,000, but our book value is only $40,000, we made a gain. Does that make sense? You're receiving cash of $45,000. The book value is only $40,000. So now you've got a gain on the sale of your equipment. All right, and the next one is journalize the transaction. Okay, let's put in what we know. We know that we're receiving cash of $45,000. Okay. Now, why did we receive that cash? Because we're selling them our equipment. So we've got to get rid of the equipment and its related accumulated depreciation. We're taking it all off the balance sheet. Why? We're selling it. We're giving it away, right? So what we're going to do is credit our equipment of $90,000. Remember, that's what it cost us. And we're also going to get rid of its related accumulated depreciation. And so, of course, we know that accumulated depreciation is a contra asset account and the normal balance is a credit. So that's why we debit it. Now, notice here that if we net the two, the $90,000 of equipment less the accumulated depreciation of $50,000, then this is where we have our book value of $40,000. Okay, so we are giving up $40,000, but yet we are receiving cash of $45,000. That means we made a gain on sale of $5,000. Okay, so that's how that kind of works. Let's do another one. This time, Lopez discards equipment that was purchased for $75,000, and the accumulated depreciation on that asset was $65,000. So I ask you, what is the book value of the asset? Well, we know that book value is cost minus accumulated depreciation. The cost is $75,000. The accumulated depreciation is $65,000. So on our balance sheet, we're going to carry this asset with a book value of $10,000. Now, we are discarding it. We're throwing it away. We're putting it in the dumpster. We're not getting any money for it. So you think, well, what is the gain or loss on disposal? Well, there's no cash. You're not getting any cash. So when you throw in the dumpster, you have a loss of the full book value, which is $10,000. Does that make sense? Because you're throwing it away, you're losing $10,000, you're not getting any money. So that's the loss on disposal of $10,000. So how do we journalize that transaction? Well, put in what you know. You know that you're going to be throwing the equipment in the trash. So we're going to credit the equipment. And we also have to get rid of its related accumulated depreciation. And that was, of course, 65,000. So if you net these together, 75,000 minus 65,000, you have a book value of 10,000, right? So you're throwing it away, you're getting rid of 10,000. You're not getting anything for it. Basically, then you are going to have to record a loss. So that's going to be a loss on disposal of 10,000. Okay. That's a little bit tougher concept. I realize that. All right. So this concept here about, well, when you have a cost, are you supposed to debit like a truck, or you're going to debit repairs and maintenance? So let's talk the delivery truck. So if you have well, not even a delivery truck, let's say a truck. If you have a truck and you do an oil change, it's going to be repairs and maintenance expense. And but if you do an engine overhaul, then you're going to be debiting truck, right? And you say, well, why? They're both costs, but why is one repairs and maintenance, and why is one the asset truck? This is how it works. If a cost that you incurred increases the useful life of the asset, in this case, an engine overhaul, you basically have a new engine, right? That increased the useful life, then you will book that cost as an asset truck. Also, if you increase the productivity of that truck, that would be a debit to the asset truck. And I'll give you an example of that. I have a friend who has I think kind of an odd profession. I guess around here, it's not that odd, but to other people it might be. He's a hoof trimmer. He's a cow manicurist. Yeah, laugh all you want, but he makes a ton of money. And what he does is he goes to all these dairies and trims their hoofs, the cow's hoofs, and it's a needed thing to keep the cows healthy. So what my friend does, he buys like a Ford F350. It has to be pretty heavy duty. Then he'll put this apparatus on his truck. It's like a cage where he'll lead the cow into the cage, and it kind of like immobilizes the cow so he can trim the hoofs. Now, because that apparatus that he put on that truck increases the productivity of what that truck can do, then that apparatus would be a debit to the asset truck. So again, if the cost increases its useful life, it had a life of 5 years, but now you put an engine in it, it extends it to 3 more years, that's going to be asset truck. If it increases the productivity, like my buddy's apparatus, then it's the truck. But if you have a cost that doesn't really increase the useful life, or it doesn't increase the productivity, then it's going to be repairs and maintenance. So here, a delivery truck was given an oil change costing $50. Well, that's a journal entry. Well, an oil change is just regular maintenance. So you say, well, if you don't change your oil, you're not going to have you're not extending your life. That's true, but it's normal maintenance, right? I mean, it's assuming that you're supposed to do an oil change. So just to get the regular life, you need to do your oil change. But the oil change doesn't extend it past what it was intended to do, right? So that's why an oil change would be repairs and maintenance. Okay. Well, that does it for me for chapter 8. Man, I did that in about half an hour. I guess that's really good. So anyway, next week, I will go ahead and we'll be talking about chapter 9. And we're going to be talking about liabilities here. So looks like, yeah. And we're going to be doing notes payable and stuff. That'd be fun too. Okay, so I hope you enjoy this, and I think it gives will give you a jump start into your homework. Make sure that you review my lecture series. Basically, you know, in Canvas, you go to that page and click on each link. It'll take you to YouTube, and you'll review those videos, and they're really short. I mean, talking 3 minutes, 5 minutes each. So I tried to streamline it. So, and they're by topic. So maybe there's one topic that you're having trouble with. Well, maybe you want to keep really hammer that one and review that one for sure, and learn it. But anyway, I hope that's going to be helpful to you. I'm going to stop the share, and I'll see you guys next week. Bye-bye.